Welcome to the Asia Pacific chapter of LaSalle Investment Management's ISA Outlook 2025. I'm here with my colleague Fred Tang and Wayne Ching. We're going to walk you through the key highlights of this report. The overarching theme for this year is that the current Asia Pacific cycle is not a simple repetition of a typical cycle. We're seeing signs of structural change or a distinctly different cycle from historical norms in the macroeconomy as well as in several real estate markets and sectors. For example, China could easily be mistaken for Japan 10 to 20 years ago, facing similar challenges with deflationary pressures and land price erosion. These signs of structural change or distinctly different cycle could have a mix of positive and negative implications for investors. And some of these outcomes may only become apparent years later. In this report, we address some of these potential implications. Let's start with Japan and China, where the most pronounced signs are observed. In 2024, Japan appears to be emerging from a period of roughly 30 years of deflation. There's still some uncertainties about whether wage growth will continue in 2025 and beyond, and whether government can provide more support to help the general population cope with the high cost of living. Given these uncertainties, the Bank of Japan might have to be mindful of raising interest rates too quickly or too sharply in the interim. This could be positive for Japan real estate, since investors tend to deploy more leverage in Japan than in other countries. Although Japan remains a liquid market in the region, investors should not overlook the potential impact of further interest rate hikes and capital market volatility. It is essential to allow for flexibility and the potential for unexpected outcomes when evaluating investment opportunities or set up business plan for existing portfolios in Japan. At the other end of the spectrum is China, where the weakest economic growth and consumer confidence in decades are prompting the central government to cut interest rates to record lows. From September to mid-November of 2024, China launched the largest stimulus campaign since the pandemic. Although these stimulus measures are a step in the right direction, they are far from sufficient to address the current economic problems. So we believe that the Chinese economy is likely to remain depressed for an extended period of time, which will continue to present challenges for the Chinese residential and commercial real estate markets. The outcome of the US election, or Trump 2.0, is adding new challenges for China and to a lesser extent for the rest of the region, particularly in the context of potential tariffs and geopolitical tensions. Before we dive into the outlook, I would like to turn the floor over to my colleague Fred to share the learnings from the trade war in 2018 to 2019.
We learned from the past trade war in 2018 to 2019. The tariffs imposed could be lower than proposed if China imports more U.S. goods to narrow the U.S. trade deficit. Meanwhile, during and after the past trade war, total exports of major Asia-Pacific economies in value terms generally increased from pre-trade war levels. Facing the new trade war, we expect companies may accelerate the divergence of supply chains, and countries in the region will have to consider whether trade barriers require a domestic policy response, such as stimulus measures. Over to you, Initia.
So taking those learnings, under Trump 2.0, China is particularly vulnerable, and to a lesser extent, Hong Kong. Beyond China and Hong Kong, it is difficult to predict clear winners or losers from the election result for now. With that said, we believe select real estate markets and sectors could benefit from supply chain rebalancing. Similarly, the tenant base for Fukuoka logistics could benefit from the reshoring of industrial productions back to Japan. Additionally, the tenant base for Singapore offices could benefit from capital flows diverting from China and Hong Kong to Singapore. The diverse and complex Asia-Pacific macroeconomic environment presents a variety of opportunities for investors with a wide range of risk and return profiles. With that, over to Fred and Wayne to share our outlook for key real estate sectors in the region.
I'll start with multifamily sector. This multifamily sector in Asia Pacific is undergoing significant transformation driven by demographic shifts and policy support. For example, there is a growing preference for renting over owning as household sizes shrink in most major Asia Pacific markets. With the exception of Japan, where the market is well established and offers opportunities for value-added strategies, markets in the rest of the region are still in their infancy, which implies significant potential for institutionalization. In the near term, we maintain a positive rental growth outlook for most multifamily rental markets in Asia Pacific, except for China, where near-term supply risk is high and tenant affordability is weakening. Investment opportunities include retrofitting of older buildings and improving amenities in Japan, multifamily projects in Australia for investors with a long or flexible investment horizon. Please be mindful, exit liquidity is not yet proven in those nascent markets. It would therefore take time to fully unlock value in the emerging sector. Turning to logistics, the dispersion of performance across logistics market in Asia Pacific has widened. Australia, Singapore, and several markets in Japan are maintaining relatively balanced supply-demand dynamics. While investment opportunities remain in these markets, logistics asset prices are high and outlook for rental growth is slowing, pushing down return expectations. In China and Hong Kong, high supply and plummeting demand have led to a substantial supply-demand imbalance and a sharp decline in rents, which is expected to continue for an extended period. Despite the correction in asset prices, investors might want to consider avoiding these markets in the short to medium term, unless they have a high-risk appetite or long or flexible investment horizons. The drastically different supply-demand dynamics across logistics subsectors and submarkets also create opportunities, such as leased or pre-leased dry warehouses and discounted prices in Greater Seoul and cold storage in select areas in Greater Tokyo. These nuances suggest that market, submarket, and subsector selection remain important, although it may be insufficient to generate the returns that investors were accustomed to a few years ago. With that, I will hand over to Wayne to talk about office, retail, and hotel.
For the office sector, office market performance across the Asia-Pacific region is likely to vary significantly according to market, location, tenant profile, building specification, and sustainability credentials. The timing of entry and exit and risk mitigation plans are becoming increasingly important. Seoul stands out as the healthiest office market in the region. For higher return strategies in Seoul, asset-level leasing plans and disciplined investment horizons are critical. Although still relatively stable, the office market in Japan sees potential risk associated with rising interest rates and high supply pipelines in select locations. Most Japanese companies are facing challenges in attracting talent. Therefore, leasing strategies that target specific tenant profiles and preferences are crucial to drive NOI growth and mitigate potential risks going forward. In Singapore, occupier fundamentals and capital values are peaking. However, freehold offices in prime locations, which are scarce, remain an attractive proposition for investors with flexible investment horizons over the long term. In China and Hong Kong, despite easing financial conditions, low liquidity and weak fundamentals will continue to impact office demand and capital values. In Australia, the weak office fundamental outlook and the high for longer investment interest rate environment suggest it is likely too early to enter the Australian office market, unless prices are adjusted to reflect these risks. For the retail sector, The Asia-Pacific retail sector is showing distinctive consumption patterns. Only well-managed retail assets that have adapted their tenant mix and market positioning in response to changing consumption habits will outperform. Adding to operational intensity, a granular asset-level approach to investment is crucial, given the performance variation across markets and subsectors. China is experiencing a pronounced consumption downgrade, which weighs down occupier demand and asset valuations. Although better than China, we do not expect real consumer spending to grow in the near term in Singapore, Australia, and Hong Kong. Some retail asset valuations have been adjusted downwards in these markets, but it is premature to consider investment unless there is a rationale for deal-specific strategies. The retail sector in Japan is characterized by a strong preference for in-store shopping and is supported by tourism consumption due to a relatively weak yen. However, consumers are cost-conscious due to inflationary pressures. There could be selective core or value-added opportunities in Japanese retail, particularly for non-discretionary and service-oriented asset types, or, to a lesser extent, tourism-driven retail tenant mix in the near term. For the hotel sector, the Asia-Pacific hotel sector offers only a limited number of investment opportunities that are attractive on a risk-adjusted basis, with the exception of Japan. The Japanese hotel market is set to continue its growth trajectory, driven primarily by domestic demand and, to a lesser extent, inbound tourists. The strong occupier market fundamentals have propelled hotel transaction prices in Japan to a record high in 2024. Wage growth, inflation, and a relatively weak yen are expected to continue to drive the sector performance in the near term. However, the performance is expected to vary across segments influenced by operational challenges, such as labor shortages and rising labor costs. There could be opportunities to capitalize on non-luxury hotels from owners who are not capable of upgrading existing facilities. Additionally, hotel operators with access to labor and greater staffing flexibility are in an advantageous position to improve RevPAR in Japan. That concludes all our sector outlook. Back to you, Alicia.
In summary, investors in Asia Pacific real estate will need to navigate in a complex environment. Investment strategies focusing on operational intensity, for example, deal execution, in-house leasing, are extremely important for creating or preserving value in new or existing investments. And for some investors, the resilience of commercial real estate prices in Japan and Singapore, as well as selected sectors in South Korea and Australia, has presented a challenge to place capital. The gap between buyer and seller expectations is weighing on liquidity, and some investors are adopting a wait-and-see approach. Nonetheless, savvy investors understand that best returns sometimes come from vintages in the wake of cyclical turning points or when signs of structural change emerging. There are still many unknowns under the current complex economic climate, coupled with the impending changes brought about by Trump 2.0. But the Trump 2.0 era will most likely lead to periodic episodes of capital market volatility. Investors may consider focusing on markets and sectors that are anchored by domestic demand. For example, Japan multifamily, Australian industrial, and those dominated by domestic capital, for example, Seoul office. In the event of significant dislocation or capital market volatility, there could be attractive entry prices or creative structured solutions to address capital stack issues for some troubled owners or developers. We went into further details on these investment trends in the Asia Pacific chapter. We hope that you enjoy reading LaSalle's ISA Outlook 2025. Thank you for listening.